Welcome to Finance. This is your online instructor, Diana Black, and we are going into week 2. And in week 2, we're going to look at some of the financial statements, the basics financial statements, the income statement, the balance sheet, and statement of cash flows. For some of you, this may be a review, but for others, it might be some new information. And we're not an accounting class, so we're not going to go into a lot of depth in each line item, but there are some general topics that we need to understand about the financial statements so that we can continue through the finance course. And then we will also look at some tax calculations in this class also. So I want to make sure that you review all of the PowerPoints that go along with Chapter 2. Read the entire Chapter 2 of your textbook. Review all the PowerPoints, and then also there's information in the additional resources area that you should review. It's going to be very helpful for you. In the meanwhile, there's a couple of topics I want to specifically point out for us to take a look at related to the information in Chapter 2 and to the financial statements. So I want to start off talking about EBIT and why it's important and what it does for us. Now, EBIT is earnings before interest and taxes. So it's one version of a profit number. It shows us what our earnings would be before we calculate interest payments and before we take off taxes. Interest has to do with our borrowing and our credit rating as far as what interest rates we get, and that determines our interest. So we want to look at our earnings before interest because we don't want our financing choice to have an effect on evaluating our actual earnings in some situations. And then also our taxes is a function of our legislation and our tax bracket, our tax environment nationally. So that's not necessarily, our tax break is not necessarily a reflection of how we are running the business, or the tax bracket that we're in is just the tax bracket that we're in due to the political climate. It's not a reflection of how we're running the company. So sometimes we want to look at what our earnings are before we look at taxes and before we look at interest. We don't want those numbers to throw us off in some instances. A lot of times we do want to look at the bottom line profit number, which is after all the interest and taxes. But for some purposes, we want to just evaluate how the firm is being run. We may want to look at EBIT, which is our earnings before interest and taxes are taken off, because those are items that don't necessarily reflect how we're running the company. So EBIT, earnings before interest and taxes, and a lot of times we're calling that operating income. When you hear people referring to operating income, they are generally also talking about EBIT. That can be interchangeable. So that's what EBIT is. It's a profit number before the impact of interest and taxes. Sometimes we want to take off the interest and taxes because the financing and the tax brackets don't totally reflect how we're running the company. So sometimes we want to take those items off and just look at our earnings without that. And that's what EBIT allows us to do. Another concept I want to talk about is liquidity. What are we talking about when we say liquidity? And liquidity is a measure of how easily we can convert an asset into cash without changing the value of the asset. So if we have something in cash, we have a certain amount in cash, then it's already cash, so we can exchange that for other items easily. It's liquid. If what we have is inventory, then we can convert inventory into cash, but there's other factors. Do people want the inventory that we have? And do they want it at the value that we consider it to be? Then we could have an asset like machinery or land or a building. So yeah, we can turn those items into cash as well, but not as easily. It's going to take a lot more negotiation, and those assets might lose value. We may consider that the machinery is worth $1 million, but we can only find a buyer that will spend $800,000 for it. So we can convert that asset into cash, but there's going to be a loss in the value. So the more liquid something is, that means the more easily we can convert it to cash without a substantial loss. So that's what we're talking about when we refer to the term of liquidity. Now, what are some common misstatements of balance sheet figures? And these are things that just kind of can cause a misunderstanding or a misstatement of the actual value of the firm. Receivables. Let's talk about receivables for a moment. Receivables are accounts that contain money that's owed to our firm. So the scenario is that we have sold something to a customer on credit for $5,000. So that customer now owes us $5,000. We have a $5,000 receivable. So that is a current asset. It's very liquid because we've already sold the merchandise. We just have a credit account with the customer and they have to pay us the $5,000. The reason receivables can sometimes cause a misstatement of the balance sheet is because some customers don't pay their credit bills. So when we have receivables, we understand that some portion of that, hopefully a small portion, is going to end up uncollectible. It's going to be customers that don't end up eventually paying us. So if we have $5,000 worth of receivables and we have a uncollectible rate of, say, 5%, meaning that 5% of all of our credit sales don't actually end up being paid, they get written off, then out of that $5,000 worth of receivable that we consider to be an asset, we've got $250 that isn't ever going to be collected. The customer's simply not going to pay us, and we understand that those accounts happen. So we've got what we're claiming to be a $5,000 asset on our balance sheet because we have a receivable that says customers owe us $5,000, but we actually know that that receivable is really probably only worth $4,750 because some of those accounts are going to be uncollectible. So that's something we have to keep in mind when we're looking at receivables and how that affects our balance sheet. Also, let's talk about inventory for just a moment. Inventory is merchandise that we've purchased, we being the firm, we've purchased to sell to our customers. So we have inventory, and that's an asset to us because we can sell it to a customer and turn it into cash. The reason this can cause a misstatement is because what if nobody wants the inventory that we have? We've got a bunch of shirts that have now gone out of style, and we have them at a specific value. Say we have $10,000 worth of these shirts, but in order to sell them, we have to sell them for 50% off, and they're only going to end up being worth $5,000. The $10,000 worth of inventory is assuming that someone actually wants to buy that inventory at that price. So because inventory values can fluctuate, that can cause some misstatements in our balance sheet when a large portion of it is inventory. Inventory items are often can be carried at values that are more than what they're actually worth, especially if it's getting to be older inventory, or depending on the industry. If it's a technology industry where things change quickly, new products come out quickly. Once you have a lot of inventory in, within a few months, a new item, a new gadget may be the new big thing, and the older models are not worth as much anymore. But we've still got them in inventory, and they're have a value to us. So those are some of the two main things that I want to point out when you're looking at your balance sheet, and part of your assets are receivables and part of your assets are inventories. Realize that those numbers are dependent on people paying their bills to us in full and selling the inventory at the full value that we have on our balance sheet. So those are big ifs that at times don't happen. So that would mean our assets are overstated when that occurs. And then just to clarify, like I said, this class is, this beginning information in Chapter 2 might be a repeat for some people who've had accounting, but if you have not, let's talk quickly about current assets and current liabilities. This current means that these are items that are going to be expected to turn into cash within 12 months or one business cycle. So current assets are things like inventory or receivables, these are things that I anticipate we're going to collect on the account or sell the inventory within 12 months. Whereas we have long-term assets, these are talking about building and equipment that we expect to keep for a while before we sell those. So current assets, assets we expect to turn into cash within 12 months or one business cycle. So then current liabilities are bills that we expect to pay within 12 months. So we've got salaries, we've got other payables that we know we're going to pay within 12 months, and those are our current liabilities. And lastly, before I go, I just want to point out to you the terms capital and working capital. You're going to see these in Chapter 2, and sometimes students get confused and think they're talking about the same thing. And that's actually different. Capital is talking about money that's used to start a business and acquire those long-term assets needed to run the business. So the capital, you might say, is the startup capital. Working capital is something different. Working capital is the money that's used to pay for the day-to-day operation. Hence the term working. This is the working capital that you're using on a daily basis to support the operations. And so the difference between the two can more easily be understood if you look at the timing. Capital is long-term. You invest capital at the beginning, and for years to come, you use those assets to run the business, to start the business and then acquire the long-term assets. So that's the capital. It's a long-term investment. Working capital is short-term. Working capital is the capital we're using on a daily, weekly, monthly basis to do the everyday business of the firm. So that's a way to keep those terms straight. But understand when you're reading through the chapter that these are two different items. So those are some of the concepts I wanted to point out to you. You're going to also do the discussion, and I believe the discussion question this week is going to ask you to talk about which line items in the financial statements you consider the most valuable as far as providing you with information, and you'll discuss how that works for you, or how the financial statements work for you. You'll also, I encourage you strongly to look at these videos. In addition to my video here, watch both of these videos in the additional resources here that are for Unit 2. You see you've got your first quiz this week, and that quiz does cover Chapters 1 and 2. And so make sure you're reviewing last week's information as well before you start that. And you see the assignments here. If you have any questions, remember you can Blackboard IM me during my office hours, and that information is posted in the instructor area. And you can also email me anytime, and you'll receive a quick response. I always have my computer open the majority of the day, so I respond to emails really quickly. And I look forward to talking with you in the discussion area, and I will ask that you have a great week.